Alright, so let's see. The first question is on IFRS 2, that is share-based payment. Fundamentally, share-based payment is actually what we call in management as a golden handcuff that is put on management to persuade them to work for the company over a period of time. In return, that we give them an ownership in the company. To be specific, this question is about SARS, that is share appreciation right. So let's go through it. On May 2012, Yanang granted 500 share appreciation right to its 300 employees. Okay, so off the bat, let's try to get something straight. So on May 2012, it means the grant date is 1st May 2012. Got it? Number of shares expected to vest is 500 shares. But then the 500 shares is to each employees. So per number of shares expected to be vested there, and then can say multiply by 300 what? Managers or employees. Are you getting the picture? Yes. Are you getting the picture? I said that number of shares expected to vest will be the number of shares for each employee times the total number of what? Employees. Are you getting the idea? Then all of the rights vested on, so the vesting date, very important, it's what? 30th April 2014. So the difference between the grant date and then the vesting date is the period, okay, the timing ratio, how you get your timing ratio. So if you check it, from 12 to 30, 14, that means how many years? 2 years, isn't it? So the timing ratio is going to be 0/2 if you want, 1/2, and then what? 2/2. But the 0/2 will give you 0 at the end of the day. So start from here and go here, isn't it? So that's it. Next.
Nhyira.
Madam.
Please, why would you say that the 300 is to one manager? What in the question made you think that way? Because I was thinking that the total number of shares is 500.
Granted 500 share appreciation rights to its 300 managers. Yeah, so what is your question?
My question is, why did you multiply the 500 by the 300 for the number of shares?
Yeah, because we can't have 300 employees, you know, because we can't have 300 shares to be given to 500 employees. It doesn't happen that way.
500 shares to
500 to 300 share employees. It can't happen. So the 500 shares is for each manager. You get the idea?
So this is just common sense approach.
No, it's not common sense. I get what you said too.
It's not common sense, but that's the idea. That's the idea. So the word each manager will not come, but it simply means that every manager, because the package is to individual managers, okay. It's not to all of the managers.
Okay.
You get the idea? Right. Let's move it. At the grant date, the value of each SAR was 10. At the grant date, per times 0 there, and the member could use what? The $10. Are you getting the picture?
So, let's go back some more.
Okay.
All of the rights vested on 30th April 2014.
That's right.
What does it mean?
That is the vesting date. That is the date or the exercise date.
That is the exercise date.
Yes. So the vesting or the exercise date. That's all. Vesting or exercise. These are the two
It
words.
means what they
That is the time that they can take all the things. All the
can
shares.
take the shares.
Yes.
They can take the shares.
Yes.
So now it's more like a
You see,
contingent.
it simply means that, you know, share appreciation rate is always contingent liability. That's why we treat it as a liability and make provision for it. Are you getting the idea? So it's like when you work for us in the next 2 years, we're going to give you these shares. So it is after the end of the 2 years that you can exercise it.
Right, he said, but they can be exercised from.
Okay, so I'm coming there. But they can be exercised from 1st May. Now, if you check 1st May, well, I know you know dates. So 1st May is just the next day from 30th April. Can you see that?
Yes.
So they can be exercised just, so when it ends, no, bang. But then they have an exercise period
Of 2 years.
of a further 2 years. So they have a period from the 21st May 2014, 2014 to what? 2016. Okay, so when it ends, they have 2 years to what? Exercise their right. Now, what do we mean by that? The reason why we can give them more opportunity like this is that the share price could go up. So instead of taking it in 2014, they can wait and take it maybe in 2016 with the hope that the share price will go up.
So you're trying to say that?
Yes.
It's like they're giving you an offer, but they're giving you to think about it within 2 years. But
They've
then-
given you an offer that you can exercise after 30th April. But you have 2 years to exercise the offer.
When 2 years is that?
Then you have no exercise, then we take it away. Now, the reason why we in practice, now this is a practical question that we picked up. The reason why in practice it doesn't just exercise at the end is that it's true. At that time, they may not have the money to buy the shares. So you need to give them what? Time. So that they can exercise that right that they work for. That's why there is an extra 2 years provided. But that doesn't mean that this will add up to our timing ratio. No. Our timing ratio is the package between the grant date and then the vesting date. You get the idea? Right. So next. And it was estimated that 5% of management would leave during the vesting period. What is the vesting period? The vesting period is the period between the grant date and then the vesting date. So even though we have 300 managers, 5% will leave. So technically we have only 95% of the employees that we're going to be taking. Do you get the idea? The fair value of the SARS is as follows. Okay, so at 30th April, it's been given to us. At 30th 2004 is 2014, that's the end. It's given to us. Then we have 30th April 2012. It's also given to us. So let's go for it. So, oh no, we are not done.
5% is going, there will only to be left on 95%.
Yes, so that 95% is 285 employees. So every workings we're going to be doing will be centered around 285 people because we have estimated. Now here also note, Elvis and Derek, the question you asked. Here also note that we are told that we are just giving one-time thing. One-time thing as far as, so for the 2 years, the 285 will not change. It's the same 285 that we're going to be using. Do you get the idea? But now look at the additional information. All of the managers who were expected to leave employment did leave as expected before what? Good news. So they leave. So our estimate was right. On 30th April 2015, when is that? That is 1 year.
5% left.
5% left. So that is 1 year after the vesting period. 60 managers exercised their right when the intrinsic value of the right was what? 10.5 and were paid in cash. In cash. So 1 year after the vesting date, 60 people exercised their right. So 60 people exercised a right of 500 shares at a price of what? 10.50. So we paid them in cash. What is going to happen is that once they exercise, it will reduce our liability. True or false? So let's put the pieces together. Now, Yanang is confused as to whether to account for the SARS under IFRS 2 or IFRS 13, the company Gromabo. You shouldn't be confused. Ah, that's why they have employed you. So let's go. So Yanang, let's go. How do we go about it? We pull a schedule up. So let's pull our schedule up quickly. I want to do something. I want to do presentation outside what I did for you. Just another way of presenting the idea. Or what do you want? Should we go with a traditional presentation?
This is what we have been doing.
It's what we have been doing, right? Okay. So in what we have been doing, let's go for it. Let's see. What we've been doing, what was our schedule? Okay, we can put year here.
Yes.
And what else? Whatever, then we get a figure here. Isn't it? So at the start, where is the start?
2012.
1st May 2012. What did we say? Now remember, 5% are leaving. So we're not going to use 300 managers, but we'll use what? 285. So 500 by 285 managers. How much is the figure? 10, isn't it? At the grant date. Am I right?
Yes.
Yeah. Can I have an answer for this? I hope nobody's confused.
This would be year 0.
Yeah, this will be year 0. So times
0 over 2.
0 over 2. So answer is 0. So close of year 1. When will be close of year 1? 30th,
April 2013.
2013. And that will be still 500 by 285. But this time around the fair value is what? 9 times 1 over 2. What do I have?
641.
6?
Why 9 cities?
Yes, because share appreciation right, we use the value. Is this the figure you got? 6412.
6412.
So what made you see 3 years instead of 2 years?
So the balancing figure increase, isn't it? Of how much? That same figure.
Yeah.
So what is our accounting? We debit what?
Expense.
And then credit.
Liability.
So we debit. So let me do that here.
So all these you have to add the credit and everything.
Not necessarily. That is why I wanted to do a pro forma.
Yes.
Okay.
That's why I wanted to do a professional presentation so that I have an expense, I have the date, I have an expense, and I have the liability.
Please, let's be professionals.
Oh.
Because the guys are confused, so if you don't do anything for them, you can sack us.
Hey, you guys. So what do? You want me to clean this? Or let's do the 2, okay? Let's do the 2 so that we see which one you choose from.
Oh, we've not copied.
Oh, you wanted to copy this?
Everything.
Okay, so another way to present this information is to put it this way. Is to put the date here. Is to put the expenses here. Is to put the liability here. Alright? Then you put workings here. It's called professional presentation. What do I mean by that? So then if I'm going this way, I'm not going to bring at the start of the year because I know that figure is going to be 0. So I'm just going to bring 30th April, okay, 2013. And the workings gave me, we had was 500 by 285 by 10 by 1 over 2, isn't it?
Yeah.
Sorry, I'm squeezing things out there. 500 by 285 by, is it 9 or 10? 9 times 1 over 2. So that the liability will be 64120.
250.
8.
641250.
Say,
Yes.
into one or two bomb by Mama Sam.
I said 250, I said it.
And so I didn't hear one.
You didn't write it.
That, are you getting the idea? Right, let's go to the second year. Close of year 1, close of year 2. Where is year 2? 30th April 2014. What's happening? Still 500 people there. 285 still there. Vesting fair value 11, 2 over 2. What do I have?
1567.
1567 500. Like this?
Yes.
1,567,000. Balancing figure increase. It's like the room is getting hot. Is it only me?
It's been hot since.
962.
Makasa.
250.
Should I put it on?
We are practicing how we'll be living up there.
Yeah, but I have to practice very soon.
Amen.
Even my uncle's there.
Stop work. Stop work. The time is up.
If I stop, probably call me about.
So look at what's happening. In year 2, if I'm going by this presentation,
Get a 9, so you add them.
Subtract.
The balancing figure,
Yeah.
you subtract, right?
Year one, year two liability from the year one.
And I yes and I yes.
Nhyira, because you've not changed your 641,250 there.
Okay. Be like this.
Yeah, that's
So 500 by 285 by 11 by 2/2, isn't it? So the liability is how much? 1,567,500, right?
yeah.
The increase.
Right, 926. No, that's the increase.
That's what I mean. That's the 962.
926. 926. Is that not the increase?
Yes, I don't have a problem with the calculation.
926.
That's what I'm confirming.
Your time for moving.
Okay, what's my calculator?
They're just messing me up here, can you imagine?
Sorry about that. 926, sorry.
926.
Instead of 960.
You still
5.
1.5.
No, 250.
250.
Sorry.
Alright? Okay, so look at it. April 2014, what comes here? The expense aspect will be what? The increase, alright? So this minus this, that gives us what? 926,250. Are you okay? So that's what's happening there. But then there is an additional information about what happened in 2015. So let's see what happens in 2015. On 30th April 2015, 60 managers exercised their rights. Okay. So in 2015, if we are having 285 people, 60 is taking it out. So if 60 is taking it out, how much money are we going to pay to them? Right? How much money are we going to pay to them? So 30th April 2015, the 60 managers will take 500 shares each times how much? 10.50. This is how much we are paying to the 60. Now, how much? Give me the answer, let me talk. C1.
5,000.
So if 315,000, remember, this is how much we pay to them. But we need to ask ourselves, now at 30th April 2015, what is the liability outstanding in relation to the share-based payments? If these 60 people are gone, then how many people are outstanding? 2, eh?
225.
So 500 shares times 225 times 12. What do I have?
Here, because we want to know how much our liability will reduce. So why don't we maintain the same number of employees? Because
That's after 1 year. You can't maintain the same number of employees, and these guys are gone. So you no more owe them.
they went on 30 people.
That's 1 year after this period, isn't it?
Yes.
2015.
Yes.
So you now have to calculate your liability as of 2015 and find out how that liability has reduced by paying off these guys.
But I'm asking that, you see, as at the beginning of 2015, they haven't come. They will go at the end, right? At the end, they will go at the end of 2015.
They went 30th April 2015.
Yes, so I mean, at the beginning of the 30th April accounting year, they've not gone. They were there.
Where? Here? Now this 14. Oh.
Yeah, so let's say at the end of, so let's say 1st May 2014,
Yes,
they were there.
they were still there.
They will go at the end of the year.
Yes, they went at the
Let's
end.
say when the year ends, can't we complete our liability without they going?
No! This is year end 2015. So we need to now calculate our liability after they've gone. I don't know if you get a picture.
Why? I think we are.
They are gone. They are no more. So now the liability for the share-based payment will exclude those guys. I don't know if you get the understanding.
I was thinking when we estimate the no allowed, it's like we know our liability before they go, then we subtract what we are owing them
From
we subtract what we pay them from our liability.
so that we include so if I understand you right, so we include them here,
Yes.
still take 285,
Yes.
and then we calculate how much we pay them.
Then we subtract.
Oh no.
Correct.
That could not be that.
Yeah, what if you take it like that? Then now and do apportionment maybe times 8/12.
8/12 how?
But
No,
there
maybe-
are different prices.
They are different prices, so
Maybe
whether
they
this
stay for
10.0.
8 months. Maybe they stay for 8 months and then
No, you can't. There is no information like that, so we can also do that.
But when we do that, because I don't know, okay, let's go.
Let's do what we have. Let's do this, then you see the difference. So, can I have arithmetic for this?
I think I did 1350000.
1, 3.
50000.
Can I have the difference? Two.
17 500.
Are you sure?
Right.
What are we subtracting?
This is from this now. And yes,
Um,
but what do we see? There is a reduction, right? And I mean what?
it's a minus.
Now look at it closely. So our liability as at the year before they came, they went was what? This figure, sorry. And when they were going, this is how much money we paid them. 317,000. So if you check this one, our total liability has reduced by this based on the estimate, but we paid them this figure. So technically, how much is our total liability? So 30th April 2015, our liability in relation to the share-based payment is still 1350123, isn't it? This is 500 by 225 by 12. Give us this figure. The question is, how much is the expense aspect that we have to treat? So our total reduction is this figure, but then this is how much we pay them. So you strike the difference. So the difference between what you paid them and a reduction in the decrease is what has to be treated as expense.
Reduction in the
Reduction in the decrease. So this minus this, what we have? What do we have?
97,500.
97,500. So in actual sense, this is how much money that we're going to be looking out for in relation to the current year about the expenses. Any question, please?
So in short, let's assume that in year 1, 5%, we estimated 5%. No, in year 0, we estimated 5% of the managers will leave. Then in year 1, we estimate, let's say 60 people went, and then the estimated now grew from 5% to let's say 8%. How down?
And so you still take your 300, you subtract the people who have left, and you subtract the estimates from it.
So you forget about the 285.
When you use the word you forget, it's not about forgetting. I don't want you to use the word forget. Each year is exclusive. So you treat each year exclusively from other years. So what happened in that year, so even at the end of the first year, you take 300 employees, 60 people left, you subtract that 60. Then you have made an estimate that another 8% will leave. 8% of the 300 people. So
You take it out.
you take it out. Then you now get a number of employees that you expect them to be there at the end of the year.
Even when they don't say that they actually left, you expect
60 people left. Then the estimate will also be subtracted.
Although you did not say that they left.
Yes.
So
That is 5% did they leave. They didn't leave, but we used
that
it.
they left. We had that.
Later 60% left, 60 people left. So that's the workings for the question, maybe.
So this is share appreciation right.
Yeah.
Now what's up the other one? How's that one like?
That is the same thing.
Share-
Just that the figure is going to be the same, isn't it?
Yes. But the idea is the same.
The idea is the same thing.
So the option that the figure is the same.
Yeah.
So in that
Because the share will be fixed at the grant date. But share appreciation rights, we use the current share price to value.
the same thing. It will fit at the grant date. But every application will be the same.
Yes,
We
ma'am.
are doing that.
Yes, ma'am.
So they can bring this and then they will just bring one price with it. Then we are in optional.
That's right.
Then what do we write? Do we write expected liability or write was reserves and what? Reserves and
So reserve, equity or reserve.
at where the liability side.
That's right.
But the expenses they already be at.
Yeah. So Derek's concern was, let's pretend to do the 285 here.
This guy, sorry.
Okay. Let's pretend to do the 285 here. So that at the end of the day, we will strike this figure from that figure. I get the idea. This figure from that figure. Possibly that could give us an answer, but I've not thought about it. Possibly, but I've not thought about it.
Nothing to give us.
You don't think. But this is what I want you to understand, that this is the principle that you need to understand. Yes, are you lost? So Cloud, a public listed company, a public limited company regularly purchases steel from a foreign supplier and designates a future purchase of steel as a hedge item in a cash flow hedge. The steel was purchased on 1st May 2014. That is not a story. That is important to us. 1st May 2014, that was when it was purchased. A cumulative gain on hedging instruments of 3 million had been credited to other comprehensive income. Okay, that means that when we bought the assets, when we credit other comprehensive income, that's a gain, right? So that means that, for instance, there is something in reserve somewhere where that reserve is carrying what? That purchases of 3 million. Are you getting it? I'll come back to that. At the year end 2015, how many years is that? That's 1 year, isn't it? Because we bought the thing on 1st May 2014. So 30th May 2015, that's 1 year. The carrying value of the steel was what? 8 million. And its net realizable value was 6 million. Okay. Okay, the steel was finally sold for 6.2 million. Alright, so what do we do here? So, somebody want to talk?
Is it about impairment or what?
Yes. It's about impairment. Once you really got it, so at 30th April 2015, look at the picture. The examiner says that at this date, the carrying value of the steel is how much? 8 million. Okay? But the fair value of the steel is 6 million. That means it has suffered an impairment of 2 million. 2 million. How do you deal with this 2 million impairment? How do you deal with this 2 million? Is that what? You did it. Yes, I know you did it. I saw you doing it. Derek also did it. Now, how do we deal with this impairment? Yes, I need brains to talk now. How do we deal with the impairment? Double entry?
Credit the receiver.
You credit a PP or what a debit.
You debit the revaluation surplus,
Mhm.
the 3 million.
Mm-hmm.
You reduce it.
That's right.
Yes.
Yes.
You get a picture? Because you've already revalued a gain in relation to that asset. Alright? So if there is a fair value, you need to what? Reduce that value. And so what is the double entry for this? We're going to debit the reserve with what? The 2 million.
Yes.
And then credit the asset account. 2 million. In other words, nothing is coming to the income statement. I don't know if they get it.
Yeah.
So nothing is coming to the income statement.
The reversal of
The reserve will left with one.
The reserve will be left with one. Correct. So that is at that date. Then look at what happened. It says that the steel was finally sold, so at June 2015. I think that is just a month after that, I don't know. It was sold for how much? 6.2 million. So what is happening? Look at it. What is happening? What do you think is happening?
That's gone up.
It was 6 million, so fair value 6, disposal, disposal 6.2, so we're making a profit of how much? 0.2. So this 0.2 was the double entry. Now what's the double entry on the entire transaction that took place here? We debit our cash. How much? 6.2 mil. Credit the assets, the steel account, the name of steel, with how much? 6. And then we credit the profit or loss in relation to 0.2. But remember, we have 1 in the reserve account. So what do? We transfer that to P&L to close it up. So 3, profit or loss, 1 million. You get it? So transfer, so this is disposal. And this is transfer from reserve will be debit reserve with a 1 million, credit what? Profit or loss. Maybe that's the first part of that question. Any question, please?
Shadow cleaning it.
It's the easiest, eh? I like that. The easiest.
but you to understand. It's serious.
Who missed it? Derek, what didn't you do? I think I saw P&L 0.2 somewhere for you.
Yeah.
Yes.
You did all that?
Yes.
But you didn't do the transfer.
Transfer, yeah,
Yes,
that's
I
the
did
thing.
it. You did a transfer.
Okay, that's the only thing I did.
That's the only thing. Okay. So that's 2 marks for you.
Now, you see, when there's a, the previous, so should we go and take, are we going to take out the reserve so that nothing will be left there?
Yeah, because
Then we take the rest of the P&L. You have to remove everything from there.
because that reserve was created because of that asset. So if that asset is no more,
Yes.
you have to take it out. There is a reserve to transfer it from. Let's look at the second part of the question before we run. On a separate issue, Cloud purchased an item of property, plant, and equipment for what? So, PPE on what date? 1st May 2013 at a cost of 10 million. The asset is depreciated over about 5 years straight line with no residual value. At 30th April, the asset was revalued to 12 million. Okay. So before we go any further, I want to find out what happened in that 1 year. So at 30th April 2014, look at it closely. At 30th April 2014, where the thing was revalued to 12 million, I want to know the carrying value. Isn't it?
Yeah.
So the carrying value is going to be 10 mil minus, remember that is only 1 year, and straight line method over 5 years, so that's 2 million. And so the carrying value will be what? 8 million. But it was revalued at 12 million. So there is what? A revaluation gain.
This one.
You got it. Ha, that's a lie. Revaluation gain of what? 4 million. How do we treat that? We debit the asset account and what? Credit. Reserve. Yes, reserve. Revaluation surplus. Then at 30th April 2015, what is that? The following year, right? The asset value had fallen to what? 4 million. But Shadiabi, the entity makes a transfer from the revaluation surplus to retained earning for the excess depreciation as the asset is what? Used. So look at it, annual transfer. I taught you this on the IAS 16. So annual transfer is going to be 4 million over. What is the life of the asset left now?
8.
Liar, 4 years. How can you give me 8 years, Nana Joa? So that will be what? 1 mil. So what's the double entry for this 1 mil? We debit the revaluation surplus with what? 1 million, and then we credit what? Retained earnings. 1 million. Sounds good?
You are calculating extra depreciation on the...
Liar.
Then what?
We are not calculating extra depreciation. We are doing annual transfer from the revaluation surplus. When an asset is revalued, depreciation is calculated on the revalued amount. So that gain, we will make a transfer from the revaluation surplus account to the retained earnings account, as it has been stated here.
Oh.
No, the examiner stated it. If he doesn't state it, we wouldn't have done this particular calculation. So this is not depreciation, this is annual transfer from revaluation surplus to retained earnings.
This is the essence of
I
that.
thought this thing is called extra depreciation. Thanks.
Is it what is the what?
What's the essence of that?
The annual transfer, you know, when we do depreciation on the revalued amount, depreciation figure increases and that reduces our profit. So when profit reduces, we need to satisfy or compensate the shareholders. In that way, we do transfer from the revaluation surplus to retained earnings. You know, dividend is paid out of the retained earnings.
So is this one a matching concept?
No, that's not matching cause. It's treatment for IAS 16. We are not done. At 30th April 2015, the asset has fallen to what? 12 million. Okay, so third, at 30th April 2015, I need to find the carrying value. So the carrying value as at this date will become the 12 million revalued amount minus the depreciation. What was the depreciation? What will be the depreciation over 4 years?
3.
And so, you sure about that?
Yeah.
You sure about that?
So it's 9. The whole figure is
The chart for the current year is 3.
9.
The charge for the carrying is 3. So 3 minus 12, 9 mil. Okay. But what is the fair value? It has fallen to what? 4. So there is a revaluation loss of how much?
5.
How do you treat this guy here?
This guy
So I want to check that.
is going to take
Me,
IAS 16. I'm using your brain here to make sure I get it.
the treatment.
I was
Yeah.
thinking you take...
Don't think. What do you do?
Okay, I took the... I set up the gain against the loss.
The retained is
The retained earnings. Sorry, the revaluation surplus.
yes.
How much is left in the revaluation surplus account?
1 million.
One. You should
3
have
million.
3 million rather.
Okay, then you put 3 million to that.
Out. Then the excess, the extra 2 will be what? Written off in the
Yeah.
P&L account.
I didn't know
So that
about
would
this
be
annual
3-2.
transfer.
Yeah,
3
3
and
2.
2.
That's right.
That's equal 1.
And it's a little for one.
How?
Because-
Yes,
because
that's
of
right.
the
Because you
annual-
didn't do the annual
Yes.
transfer.
because of
I
the
did, okay,
annual-
I did the annual transfer,
And it's
but
still
I forgot to
take it into
out.
account.
Yes.
Okay, so that's how we treat it. So this 5 will be segregated into that 2.
So, and he said the annual transfer came as a result of what the examiner said.
Mm-hmm.
So, on a normal day, if the examiner had not done that, it would have been 4, 5. Like I'll set the 5 against the 4. And we'll be left with 1 million.
Yeah.
Yes.
Okay. But what statement did you say led to that?
That's my question. The entity makes a transfer from revaluation to surplus. From revaluation was surplus. So it says.
So that's a 5 mark.
This was the tricky thing. Oh.
Oh, you do it. This one is to come.
And the treatment to the debit,
Oh, God.
So we debit revaluation surplus with 3 million. Debit the income statement with 2 million. And then we credit what? Property, plant and equipment with 5 million. So that's the account.